Good day, traders. This is Roger Scott from Market Geeks, and I have another video tutorial for you today. Last week, I did a short video explaining relative strength and how to use it. I promised I would do another video to show you how to equalize your positions. That's the topic for today. Before I begin, please don't forget to visit MarketGeeks.com for your free swing trading report. And don't forget to subscribe to our channel for swing trading tutorials and more trading tips. What is position equalization and why is it so important to understand? Let me give you a quick example. Let's say you trade stocks and you trade more than one stock at a time. Let's say, for example, that you trade two stocks using the same trading strategy. For the sake of simplicity, let's say you trade breakouts and you pick two unrelated stocks to avoid correlation between them. Your first stock is Clorox, the bleach manufacturer. Here's what the stock looks like before you enter your order to go long. In addition to buying Clorox, another stock is also setting up for a breakout pattern, and it happens to be an unrelated software company, so there's little correlation. You may have heard of this company a few times in the past too. They're the largest personal computer security company in the world. One stock sells bleach, and the other one sells security products for personal computers. Totally unrelated, which is great. Now we have to figure out the most important question. How many shares do I buy of each stock? If you don't make your positions equal, your profits and loss for each position will be different and your trading results won't be balanced. For example, let's say you have 7 winners and 3 losers. If your winners are $1 and your losers are $3, your trading is not balanced. Your losers and your winners should be very equal in size to each other. This way, regardless of what market you trade against another market, it will appear dollar-wise like you're trading the same markets. When looking at your brokerage equity report, the size of your winners and losers should be approximately even between your entire portfolio. Here's an easy process that will help you trade any technique using balanced positions. The tool that I use to equalize my positions is the ATR Indicator. The ATR stands for Average True Range, and it's simply a daily calculation of the average trading range for each stock. You can figure out yourself, but most trading software online and offline has an ATR indicator already built in. All you have to do is set your average range to 10 days. It's usually set at 14 days by default. The ATR indicator will tell you what the average trading range is for each stock that you trade. In our example, Clorox has an average range of 74 cents per day, while Symantec has an average daily range of 43 cents. You can easily see that Clorox is almost twice as volatile as Symantec. So trading equal shares wouldn't produce a very even profit to loss ratio between both stocks. Start with figuring out how many shares you would trade for most volatile position out of the two stocks. In our case, Clorox is clearly more volatile than Symantec, almost twice as volatile. So we will figure out how many shares of Clorox we want to trade first and then equalize Symantec to that level as well. To make this simple, let's say we want to trade 100 shares of Clorox stock and you want to know exactly how many shares of Symantec stock will give you the same bang for your buck as Clorox stock. Simply divide the larger position by the smaller position and multiply that number by the shares. In our example, the larger position's ATR is 0.74 cents and the smaller position ATR is 0.43 cents. You will divide 0.74 by 0.43 and it will come up with 1.69. You multiply that result by the amount of shares you choose to trade, the more volatile stock by. Since 100 shares were chosen for Clorox stock, you would multiply 1.69 by 100 shares and you will get 169 shares of Symantec stock for every 100 shares of Clorox stock. Many traders focus so much on being profitable that they completely ignore the most basic and important principles, such as making sure both positions have equal risk and reward profile. Regardless of the stock swing trading techniques you pick, you need to make sure you're trading apples to apples and not apples to oranges. Take a look at how both trades would have worked out for you. Notice how the volatility changes as both stocks rise. Volatility needs to be adjusted as both positions will increase or decrease in volatility. Both Clorox and Symantec have different ATR levels than when we first entered the order. A good practice is to recalculate your ATR every few days to make sure your positions are as equal to each other as possible. That's it for today's tutorial. Please don't forget to visit Market Geeks for your free swing trading report and subscribe to our channel for swing trading videos and trading tips. This is Roger Scott wishing you the best in your trading.